It's a pleasure to introduce this distinguished panel. Actually, no, I'll have each of you introduce yourself, please, if I may. As far as I'm concerned, I work in community investment management. We provide strategic debt capital to early stage financial technology companies, both in the US and in emerging markets. So Nelson, can we start with you?
Sure, absolutely. I think I had this panel slot last year as well, and there's only 6 people, so this is like progress in the grand scheme of things. Very much appreciated. My name is Nelson Chu, founder and CEO of Percent. We are built a modern credit marketplace, and so we've effectively create software for borrowers who need debt capital, underwriters who structure it, investors who invest in it, facilitating everything from sourcing, structuring, syndication, surveillance, and servicing of private credit transactions. So slightly relevant, slightly irrelevant for this panel, but I think the part that is relevant is the fact that we actually do offer alternative investment products in private credit to retail credit investors, and it's becoming a bigger and bigger part of people's portfolios. So we've done about $1.2 billion in volume so far, and it's growing pretty nicely. So happy to be here.
Hi, everybody. My name's Sean DeClercq. I'm the founder and CEO of Kickfurther. Kickfurther is the world's first and only inventory asset marketplace. So on Kickfurther, product businesses can get the liquidity they need to fund their inventory so they can keep growing. And people that want to buy yielding inventory assets and have liquidity to deploy can do so through our marketplace and build a diversified portfolio of inventory assets across hundreds of product businesses.
Good afternoon. I'm Eric Satz. I'm the founder and CEO of Alto Solutions. We enable individuals to access their retirement accounts, their retirement money, to invest in alternative assets. So if you want to do some duration matching and portfolio diversification, with Alto, you can access your IRA money, and you can actually invest in a lot of the assets that you find represented by the other members of the panel. So a way to take long-term investment dollars and use them in long-term assets.
And I'm Alan Sokolitsky. I'm the CIO at Masterworks. Masterworks is the first company to ever make art an investable asset class. The company was founded in 2017. So we've been around for a few years now. We have a retail business. We have an institutional business. Our firm AUM is 800 million. Actually, it's probably a bit north of that, but let's call it 800 million. And in about a year and a half ago, we had a Series A, which valued us at just over $1 billion.
Fantastic, thanks for this. Well, we have a breadth of perspective here on alternative investments on this panel. Well, we think of alternatives as an asset class that doesn't fit into any conventional like equity, fixed income, cash. I would love for each of you to please talk about the unique nature of what it is that you do. If you can provide important highlights, what exactly makes you an alternative investment? What are the strategies that you're using, and how you define also internally in your firms the alternatives? And Alan, I would love to start with you because I think most investors don't necessarily think of art as an asset class to begin with. And I think the most basic questions would probably be the most interesting. I would love for you to speak about how big the asset class is, what sort of long-term portfolio returns you deliver, and how do you compare to other asset classes?
Yeah, so that is an excellent question, and if we had a lot more time, I would be able to talk about this all day. But you know, the question of what is an alternative asset, it's going to be different for everyone that you ask. I spent most of my career actually at Goldman Sachs, and I was publishing a lot of asset class-oriented research. I covered stocks, bonds, commodities, private equity, hedge funds, real estate, like literally everything that everyone already kind of knows something about. And while there, the idea of an alternative was probably similar to the idea of an alternative for a lot of other people, which is to say, if it's not stocks or bonds, it's probably some flavor of an alternative. And the truth is, in most cases, that is in fact a reasonable definition. But when you move over to a company like Masterworks that is making art an investable asset class, and art, of course, being something that almost nobody has ever purchased from a pure investment perspective, And what I mean by that is, you can buy a house, let's say, because you want to raise your family there, you love the neighborhood. There are a lot of non-financial oriented decisions that go into that. But what I'm saying is, think of it somewhat along the lines of buying investment properties, right? Where you might not ever care to live in that house, you might not like the neighborhood that it's located in, but you think it's a really good investment opportunity, and that's the only reason you might buy it. We're basically doing the same thing with the art market. So for me now, I'm in a position, it's a good position, where I can basically say, I define alternatives as everything that's not only not stocks and bonds, but I don't consider private equity an alternative. Why? Because private equity is just public equities with better returns and lower volatility because it's only marked quarterly. I could say the same thing about a lot of other asset classes, but again, it's because I'm in this position that I'm in now that I can say those things. So art, it's most definitely an alternative asset. If you look at its correlation related to any other major asset class, and I'm not going to rattle off the whole list, there are more than a dozen of them, the correlation is close to 0, which probably makes it among the most unique of any asset class in the world to have a consistent correlation of 0 to anything you measure it up against. And in terms of performance, maybe we can get into details later. I don't want to monopolize this here. The segment of the art market we focus on is post-war and contemporary. That's the segment where you get the best performance. That segment has been appreciating over time at about mid-teens annualized levels, which anybody that's been in the investment management industry long enough, if there has been this asset class off to the side that you never bothered to look at and it happens to be appreciating at 15% or so annualized, at some point you're probably going to scratch your head and wonder, how is it possible you never thought about investing in it before? So that's the segment we invest in. Our performance has been good. We've sold 13 pieces already. Net return, the average was 25%. And that's excluding a piece we actually sold 2 months ago that we sold after holding it for only 2 months. That was a 325% net return to investors, but that is a total outlier. Do not expect that to happen again. But nevertheless, we're an investment firm, and we're in the business of generating returns, so that's what we're doing.
Anybody want to define their own internal alternative definition?
Sure. I think what Alan said is spot on if you work at Masterworks. And Masterworks is a partner of ours, and we're fans. We define alternative assets more broadly, which is to say it's a non-publicly traded security. So it includes real assets like artwork. It includes real assets like collectible automobiles or Michael Jordan sneakers, or a Babe Ruth baseball card on the one end. For us, it also includes private equity and venture capital and direct company investment and private credit with percent. So our whole goal is to both enable access to this broader class of alternative assets, and by doing so, enable portfolio diversification, which leads to reduced volatility in an overall portfolio and higher returns. So we take a broader brush.
Can I just add one more thing, because I feel you just made me feel bad for a second. The definition question, it's important up to a point, but I think it also misses a more important point. Whether I call private equity or private credit an alternative, or if someone tells me that it's called applesauce, neither of those things actually make a difference at the end of the day. Because if you ask me the more important question, which is, do you think private equity or private credit belongs in a portfolio? My answer would be 100% yes. So, it's kind of semantics in terms of whether you call it an alternative or not. The point is they belong in a portfolio no matter what you call them.
And there's just ranges, right? I think at the end of the day, which is what you're kind of getting from all of us here. I think there was a lot of alternatives that came out of the post-COVID environment. I think art has been around for a long time, but I think accessibility is very different. But you saw, investing in wine, investing in sneakers, investing in cars, like partial ownership of all those things. And that, because in a very low interest rate environment, in a very free-flowing cash environment, it was a very attractive opportunity. But we are on probably the least alty of the alt side of the equation in that it's just credit, but it's private instead of public. So on the private credit side, for us in particular, it is something that, while I can't directly recommend it, and I'm extraordinarily biased, it is something that at least the Apollos, the Blackstones, the KKRs of the world that are extremely good asset managers are definitely recommending right now because it is distinctly uncorrelated, similar to the way art has been historically as well. So it's uncorrelated because when you structure it, there is an underlying asset that's designed to perform one way or the other, right? And so even in times, which we'll get to in a second, around market volatility or just high inflation or high rate environments, you still have the ability to create outsized returns and alpha because of the way it's been structured to protect your ultimate investment at the end of the day. So it's an interesting space that we're playing in. I'd like to think that I think every other asset class had its heyday for the last few years and finally we're peaking at the right time, but it's been a long time coming. We've been around for 5 years. 2023 we believe is the year of private credit for sure.
Yeah, and I would say I'm just broad agreement with what everybody said here. It's like alternative is just a very broad definition. Like the businesses we work with, their inventory is their main asset, right? Primary asset, not alternative. It's the way they make their money. And the way I see it is it's like alternative is just not mainstream, right? And what you said, it's inventory hasn't been publicly available, right? So what ability has there been for a fund manager to add inventory into their portfolio up until very recently? It's been practically nil. So it's alternative until it's mainstream. And then when you see broad mainstream adoption, suddenly, we're going to be on a different panel, right? So.
Well, now that we've defined alternatives, why don't we, poorly, broadly, let's talk about financial sustainability. In the current market environment, we all, investment managers, investors themselves, regulators, are all concerned about financial sustainability. If we think about it in terms of strong capital sources, profitable business, transparent reporting, efficient planning, I wanted to see how your strategies deliver on these pillars. If we can talk about how your companies, your product offering mitigate these financial stability risks, including handling the situations of liquidity distress that we've experienced recently. And Eric, can we start with you? If you can, tell us how your strategy, basically puts the conventional wisdom upside down, right? We're not taught in school to take risks with our retirement savings. So if you can talk to us how you deliver financial sustainability.
So what's really interesting is depending on who you're speaking with, if you tell them that you help individuals invest their retirement savings in alternative assets, you kind of get one of two looks. One is, well, that sounds stupid and risky. And the other is, where do I sign up? And on the first, the conventional wisdom undeniably is that you should not take risk with your retirement money. I think we got that one backwards. You shouldn't touch your money until you retire. The US is one of the only countries in the world that actually allows you to access your retirement money before you retire. What you should be doing is investing on a long-term basis with the expectation that you will achieve an illiquidity premium as opposed to a public market liquidity discount. And so again, and I kind of said it earlier, from a duration matching standpoint, these are the dollars you should be using to make these long-term investments. They're also tax advantaged. In the case of a Roth IRA, you've paid taxes before the money went into the account, so that when you retire and those returns come out, it's tax-free. In the case of a traditional IRA account, you're getting the benefit of compounding returns over time, something, I don't know if he said it or not, but Einstein tends to get credit for, calling compounding returns or compounding interest the eighth wonder of the world. And so if you have this opportunity to take outsized returns and reinvest over a 10, 20, 30-year period, I think you should do that. For the money that you may need on the, at the drop of a hat, right? Use your after-tax dollars. And by the way, I'm not anti-public markets. I think public markets belong in a portfolio. I just don't think it's 60-40. Maybe it's 20-20, 20-20-20. I don't know how many 20s that was, but it was supposed to be 5. And so from a financial stability standpoint, again, it comes back to this free tool that not all of us actually had at our disposal until more recently, which is diversification. And because of what everybody else here on the panel is doing, whereas you used to need $250,000 maybe to buy a commercial property or, $2.5 million to buy a Picasso, now you can buy a piece of it for $250. That's a big difference today that didn't exist, 10 years ago.
Not to say this is the recommendation or investment advice, but I'm pretty sure Peter Thiel invested in Facebook through his Roth IRA, and it's like worth a couple $billion, and he's paying no taxes on it. So it does work. And you guys have access to equities too, the ability to do that.
He did do that, by the way.
There's been a lot of research that came out over the last year on the idea of retirement money and how to sort of change the mix and the strategies you employ in your retirement strategies over time, right? So let's say you're just starting out in your career, you've got decades until retirement happens versus you're at the point of retirement. And one of the most interesting pieces I read, and the funny thing is the argument was actually so extraordinarily simple, and yet it had never crossed my mind before, and it just seemed to me at least, it made so much sense, which is, the common wisdom is you take more risk when you're younger, right, because you have the luxury of time, and then slowly you bring the risk down over time. But the article was actually making the case, we haven't taken that risk piece of the puzzle far enough as we can. If you keep in mind that you're not going to be retiring for literally decades from now, why aren't you actually borrowing to invest early on? Why is the starting point invest whatever you have, which, by the way, by definition, if you're just starting out in your career, how much could you possibly have at that point anyway? Why is the starting point take whatever you have and start to invest that in a risky way? Why isn't it borrow as much as you can to invest because you have a multi-decade time horizon? So anyway, I guess it's all just a way of saying, I think the literature has been sort of reevaluating what does it mean to invest for retirement. And I would definitely echo all the points that Eric just made. It brought to mind this other piece, which is you should be taking more risk at an earlier stage because this is money that you're putting aside for 40, 50, however many years from now anyway.
And now if we turn to performance measurement, Sean, I'd like to start with you. I'm curious to know, what are the relevant benchmarks that the investor would make a decision upon to compare your performance to that of others? I mean, the panel is so diverse. Everything that you do is so different. How does one decide or measures the alpha that you deliver?
Yeah, so this is something our data team solved for us. And so the nature of inventory, when you fund inventory, is that the sales are uncertain. And so we invoice and ACH debit and distribute the proceeds every 2 weeks. So it's like, a lot of e-commerce businesses, you'll sell 200 pieces, then 500 pieces, then 300 pieces, then 900 pieces, right? And so you get these uneven, usually, paybacks with the e-commerce or other product businesses that we work with. If you're diversified, talking about stability across 500 of them, right, that smooths out nicely for you. But the idea is that you need to look at an uneven payback timeline. So the formula is like an XIRR formula, and it just annualizes the profit you earn in a period. So you might earn, let's say, 10% consignment profit in 6 months. We're going to, rough math, annualize that out to a 20% annualized profit. And our platform on that measure delivered 14.4% annualized consignment profit for the relevant period.
Fantastic. Alan, what about you? I mean, it must be really long-term returns, and how does one...
Everything is 325% in 2 months.
Oh, God, please don't let that be the takeaway. It is a long-term investment. Art is an illiquid asset class, right? It's not like a stock you can go buy on the stock market, buy it now and sell it 30 seconds later if you want to. The expected hold period for each of the investments in our paintings is 3 to 7 years, so it's a multi-year time frame. As a side note, we do also offer a secondary market, which gives the investors the ability, if they need to, and we emphasize this to all of our investors, do not look at the secondary market as a sort of ideal place where you can sell your shares. Look at the secondary market as all of a sudden you find yourself in an unexpected situation in life, you need to raise cash, and you need to sell the shares that you originally were totally fine holding for several years, but all of a sudden you need that money now. That's what the secondary market is for. The way that we think through if we're delivering or not is, depending on who you ask at our company, you might get a different answer, but because I come from a very sort of investment management asset allocation background, I think about this a little differently from others probably. The way that I think about it is, if we're delivering performance that does not look like the performance you're getting from any of your other investments, then we are doing our job. It's in those simple terms. I could quote big performance figures. Actually, I think the first thing I said was quoting big performance numbers before. But I don't think that's actually the best explanation. So last year, when most public markets and even some private markets were down, we were up on a net basis in the mid-single digits, which on a relative basis is extraordinary. I would imagine most investors in a year like last year, if you could have eked out a mid-single digit net return, you'd probably be pretty happy relative to your friends who might have invested in the stock market. But I think the point I would really hammer home is, if we are delivering performance that just does not look like anything else you have in your portfolio, then we are doing our jobs. And if you're wondering, well, how's that really even possible? I mean, how is there this investment out there that seems to be so uncorrelated to anything? The best way to understand it is to think through, who are the people that have always been involved in the art market, and frankly, who dominates the art market now? It's ridiculously wealthy individuals and families that probably number at most in the thousands all over the world, and even that's probably too high, but let's just call it thousands. And their decision-making on whether they want to buy multi-million-dollar works of art, I can guarantee you they don't wake up one day and decide that they want to buy a Picasso and then change their mind because, oh wait, it looks like the economy is headed towards a recession. I'm just not sure I'm going to buy that Picasso I love. Those types of people and families don't typically make decisions that way. If there's a Picasso that they've always wanted to buy and it's all of a sudden coming up for sale, they're going to buy it even if there's a recession on the horizon. It's just a totally different mindset. And because the art market is in so many ways removed from the macro environment, that's what allows us to deliver the performance that we do, frankly, no matter what else is going on in the world.
I think for us, I have been always striving to hit the 325% mark for any of these private credit investments. We have missed the mark every single time. I'm so sorry. We do deliver consistently reliable 15 to 17% returns in this market at the very least. But I think for us, what we benchmark ourselves to is really the fact that private credit tends to be a lot more shorter duration, what you'll see in public markets or public fixed income markets at the very least. And so while public market fixed income has still been longer duration, stayed relatively low relative to what you can get right now, we are consistently tracking about 10% above the Fed funds rate, basically. So prior to the Fed raising rates, we were tracking on average 11% consistently. Now it's closer to like 15, 16, 17%. But on top of that, it's really about delivering that consistently across the board, right? So when you put investment into us, if you invested over the course of the year, if you can get that number, then we've done a really good job. There's going to be, potentially defaults, there's workouts, recoveries, things like that. That's just part and parcel with the private credit market. But if we can hit that target, we've done a really good job. And our ability to be able to give you guidance and comfort around that also stems from the fact that we're pretty transparent in how all these things are doing. So we actually publish reporting every single week for every single one of these investments. And so you can actually see how it's actually doing relative to what was promised and whether they actually are doing what they say they were going to do. So private credit is, I would say, far less volatile, far more predictable in that regard. But sometimes in a market like this, that's not a bad thing. So I think that's the reason why private credit has been getting so much attention right now in particular.
And if you invested in all these assets with your retirement dollars, you can just gross those returns up by your tax rate. So it's even better.
I do hope there will be questions from the audience, but personal question that I have, Alan, again for you, is how do you source your art? Like, it seems like such a, I mean, in my mind, such a limited supply. What's the secret sauce?
So one of the things that is not, that I've learned, it does not seem to be appreciated by most people, is actually how enormous the art market actually is. So if I told almost any investor of any sophistication that the private equity industry in the United States is very large, I don't think anybody would dispute me on that fact. You don't even need the exact numbers, but private equity is a huge business in the US. As it turns out, the art market is actually half the size of private equity. Now, anything that's half the size of private equity should be on investors' horizon, like as something they want to consider, on their radar actually is what I meant. Private credit is actually a slightly smaller asset class than art. By the way, I just want to be clear, that is not saying anything bad about private credit.
Killing me here.
No. The point I'm actually trying to make, in fact, to your point, private credit is an attractive asset class to invest in. My point is really that if private credit is a smaller asset class than the art market, and many investors are familiar with private credit, and if the art market is half the size of private equity, and basically everybody's familiar with private equity, how could it possibly be the case that an asset class as big as the art market, which is sitting right there in the middle, just goes completely overlooked by everyone? And I think, honestly, a lot of it really just comes down to the fact that nobody had an ability before Masterworks came around to actually invest in the art market. I mean, to keep it really simple, if you want to buy one painting in the art market, that will often cost you millions of dollars. Can you imagine yourself building a diversified portfolio where a single investment itself is going to cost you millions of dollars? That's not very easy to implement for the vast majority of investors around the world. So until Masterworks came around to actually fractionalize every one of these paintings and give investors access, there was no way to do it. And if there was no way to do it before, then why would anybody care how big the art market is? Why would they get involved? It just doesn't matter. Well, now that we exist, all of a sudden people care. So the art market, it's actually, by today's numbers, I'm estimating probably $2 trillion in size. Like I said, half the size of private equity in the US. Our sourcing, so our company is actually a funny combination of people who have extensive art market backgrounds, so they've worked at auction houses, galleries, dealers, their whole careers have been in the art market, with not a lot of like true financial services experience, kind of like the experience I had. And then you've got the other side, which is a lot of financial services experience and not a whole lot of art market experience, but for a company like ours, you need both sides to actually make the company work. The art-oriented individuals, they grew up in the art market. They have extensive networks with collectors directly, by the way, from all over the world, as well as, of course, as the auction houses, so on and so forth. But the point here is, to get to your sourcing question, we have probably the biggest network of art, I'll call them art-oriented people or institutions from all over the world. And what that allows us to do in most cases is to buy and sell paintings with individuals or intermediaries directly, rather than going through auctions. One of the big misconceptions in the art market, people sort of assume that, oh, when art gets bought and sold, that happens at auctions. It's actually very far from the truth. Most of the transactions in the art market take place privately. If you're wondering, well, why would private be better than public at auction? The reason is you get to bypass enormous fees that happen at auction. Nobody realizes that if you're going to sell something at auction, you're basically looking at fees that could easily add up to 30 to 40% of the cost of the painting. And remember, the paintings we're talking about are millions of dollars, so it's 30, 40% on top of that. So we have an extensive network, and that basically allows us to buy and sell directly with a lot of collectors and intermediaries, and that ultimately ends up with a huge cost savings too.
Thank you for that. Now I'd like to put your businesses in the global macro context, with the rising inflation and interest rates, with energy insecurity, geopolitical risks. What are your fears or opportunities for your businesses? How does your investment strategy adjust according to this risks? And how are you readjusting, or what are the new ideas that you're having currently?
Looking at me? Okay.
I'm looking at you, but we can go in order.
Yeah, no, of course. So I think this is a bit of a new normal, right, in some respects. And the one thing that you can predict about the future for at least the next 12 to 18 months is that it's going to be very unpredictable. So to that end, then, I think we viewed private credit as something that is slightly more defensive in some respects as well, just based on the short duration nature, the ability to structure the risk away. And I would argue that in this current environment, this is actually way easier than COVID, because COVID was a situation where you modeled all these different things like, oh yeah, maybe the portfolio is going to default like 50% and you'll still be okay, don't worry. Like during COVID, there was no money coming in to small businesses and consumers weren't able to do things. Like it was just absolutely crazy. And so the fact that private credit actually survived and thrived through COVID is making this time around a lot easier as well. Some things that we're seeing, since we do monitor this on a regular basis, is the fact that consumer credit, for sure, in this inflationary environment, is definitely having some challenges, without a doubt. But again, you can structure that risk away in many respects to just make sure that every single time these deals come back out to market, you're seeing the performance change a little bit, and you change the structure a little bit, and then you'll be okay. We're still seeing a lot of strength on the small business side that will continue to hold up probably for the foreseeable next few quarters. It's heavily contingent on what the Fed does, because I think if the Fed keeps raising rates from here, which they probably won't do at this point, you're going to see a lot of distress just in general in the credit markets, in which case, you're going to have to figure out sort of how you want to allocate accordingly. But based on what we're seeing right now, it's still, whether it's US, emerging market, doesn't matter. It's still a very, very good time for private credit as long as you play a diversified approach with everything.
Yeah, so this comes up pretty often, right? Like, how's the macro environment going to affect things? So one of the views that I've had for a long time is that inflation kind of indicates to me that goods are going to be selling more tomorrow than they're selling today. And so that's a really good time to turn cash into goods. And so I feel like that's a tailwind for our platform that allows you to buy inventory and place it on consignment with product businesses. To your point, the COVID was like this weird little mini like cycle, right? Where it was like credit just disappeared and then it kind of came back relatively quickly. We're seeing the same thing happening right now, and slower though, right? COVID, it was like overnight with the shutdown. Now it's like as these banks are failing, everybody else is like slowly and slowly and slowly tightening up. So we're seeing a lot of very good businesses looking for funding, seeking funding, not being able to find it. And that's really tough. And I think it's kind of like probably true for our assets as it would be for like equities, that it's like when the tide goes out, you find out who's swimming naked. Like we see some product businesses that, they were relying on that next equity check, right? And they were selling $1 for 80 cents. And if that next equity check didn't come in, they just didn't have another plan. They didn't have a plan B. And those guys are hurting. It's a tough time for them. But good businesses that have reasonable growth, that know to look at their business models, know to say like, my unit economics, this is how much it costs for me to buy and to sell and to blah, blah, blah. Those businesses persist, right? And the supply chain challenges that we saw in, through COVID have eased up, right? Freight prices are down, like it's easy now. The supply chains are much more open. And so, barring China invading Taiwan or something like really crazy, which isn't out of the question, I think the economy is going to keep going. People are going to, jobs are up, right? People are going to keep buying stuff, like wages are up. There's going to be some weirdness in the financial markets. It's going to be a little bit tight, but I'm relatively optimistic that like it's going to be tough for a while, but we're going to make it through, right? We're all going to make it. And in like 12, 18 months from now, I think we're going to be looking at a much sunnier future.
The macro level stuff is kind of just noise to me. It's certainly beyond my control, and I think beyond control for most of us. And I think instead about a sweeping change that has been happening over the last 10 years, which is the idea that more and more people should have access to these asset classes. And I think we're in the very early innings of that, sorry for the sports analogy, ball game. And so whatever's happening in terms of inflation or where the public markets are, I'll say the one thing that really worries me is the debt ceiling. That is an enormous wild card. And
I
I've
always figure it out by the end of it at like 11:59 p.m. and then everybody's fine. It was all just a ruse, but yes.
and I hope you're right.
Eric,
But
I think you're addressing audience's question, whether you think the alternatives should be available to more widely available, and whether they should be available to non-credit investors too.
yeah, thanks.
So I guess your answer is
This is exactly where I was going. So, yes, I am 100% of the belief that alternative assets should be available to all. I think the idea, first of all, I think we have a very paternalistic regulatory system and structure that maybe was justified in the 1930s, but not justified today. And if you think about what it means to be an accredited investor or a qualified client or a qualified participant, it's all about how much money you have or are earning. And I can't remember who said it, but the saying goes something like this, which is that money does not beget wisdom, but wisdom may beget wealth. And so the idea that individuals, just because they're not earning a certain amount of money today, or they're not already worth a certain amount of money today, can't appropriately assess the risk and return of a given investment, philosophically, I just have problems with. And if what you want is a test, I don't think it should be monetary in nature. I think we can create a test that will still be approximate, but if passed, opens the door for more people to participate in these asset classes, which only the ultra high net worth individuals are allowed to play in today. And so, yes, I'd like to see us blow those doors open.
One thing I'd mention, so for our investments, you don't need to be accredited to invest, to buy shares in these artworks. I'm not going to bore you with the mechanism of how we make the paintings fractionalized in the first place, but these are actually technically public vehicles. They're not public in the sense that the stock market is public, but they are public in the sense that it's available publicly to anyone who comes to our website and wants to buy shares in the paintings. So you don't need to be accredited. And you know, the answer to that question about whether these types of investments should be made for everyone, the one thing that I always said throughout my career, even when I was at Goldman, forget Masterworks for a second, was that the most important question about whether or not to make a particular investment, the answer to that question has absolutely nothing to do with how much money you might have or how much you make in any given year. The answer to that question, the most important question in the world, is how much of your portfolio do you plan to invest in that thing? That is the most important question. So it's really as simple as, let's say you take a very unsophisticated investor. What is the worst outcome that's going to happen if that not sophisticated investor decides to put 1% of their portfolio, hypothetically, into an extraordinarily illiquid, risky, come up with all the bad words you might want to come up with, investment? What is the worst outcome? They've lost 1% of their portfolio. So to me, the more relevant question, no matter what the investment opportunity is, doesn't matter if it's art or anything else for that matter, the question is, if you size it appropriately in your portfolio and you understand what the risks are, there's no reason that the size of the portfolio itself should automatically preclude you from considering a specific investment.
So I think we can actually address some of these question 2 and question 4 too, because it kind of goes together. But the reality is we are obviously more of an infrastructure provider than we are a alt investment platform behind the scenes. So we do track all that information, right? And what we're seeing right now is, unfortunately, accredited investors, retail investors, they flock to liquidity when there is market uncertainty. That is just their behavior, right? Inevitably. And so accredited or not doesn't matter. They just need things that are inherently more liquid just in case something goes south and they need to be able to have cash. So we're seeing demand from retail investors taper dramatically in the last, call it 6 to 12 months. We're seeing all the stats come in. But at the same time, we're seeing family offices, institutional investors double down on things like private credit right now because they know that this is the time to do it. And so you're seeing this kind of this split between both sides that is just very interesting to observe. So even though alternatives are a interesting, uncorrelated asset that should be interesting for retail investors, they are inherently afraid in environments like this because they need to know that they can get cash out at any given point in time. So you can give them all the options you want in the world, but you can't fight that liquidity or illiquidity premium in some respects. And that's what I think a lot of these alternative investment platforms are going to have to grapple with for the next, call it 12 to 18 months realistically.
I see a lot of questions from the audience, but we're out of time. The timer is blinking unless one of you wants to address like the bottom one. I don't know if we have, but I mean, we're out of time. So what I would like to do is to let everybody go enjoy whatever is left from the conference. And if you can help me thank the panel for attending and for your words of wisdom. Thank you.